For this session, we're going to do something a little less conventional. I've invited a historian to come talk with us, and he's going to talk a bit about some of the results from a book that he has just finished. It's actually forthcoming. Destin, I don't know exactly when it's going to come out. Maybe you can tell us a little bit about that. But I was hoping in this session really to give a historian's perspective on a lot of the issues that we also study as economists. And this came out of my experience. I team taught a class with a historian, and every week we would have readings and subjects on a particular topic, and they were radically different and really described radically different realities about what we thought was going on. So I thought it'd be helpful in this session for this conference to get that perspective out there. So I'm really pleased to have Professor Destin Jenkins from the University of Chicago. The floor is yours.
Thank you, and good morning, everyone. It's a real pleasure and privilege to be here. I'm a historian, as Dr. Bostic said, who teaches at the University of Chicago. My main areas of interest are the United States, 20th century US history, racial inequality, and such. So let me just kind of begin, because I don't have all that much time, by thanking the Bynum Center for Finance, and of course the Federal Reserve Bank of Atlanta. Thanks as well to Professor Brunemeyer for the occasion. And of course, I have to extend my deepest gratitude to Dr. Bostic for the chance to be in dialogue, and frankly, just for his courage in using his platform and the Federal Reserve to bring attention to the problem of racism. So alas, as a historian, I don't have any slides, and I don't have nice charts and data points, really just some selections from the archive and a few interpretive claims. That really kind of lend itself to, as I understand it, the broader objectives, or one of the objectives of the conference, which is to encourage scholars of finance, students of finance, to think about structures, to begin to consider the structural interpretations of inequality and the allocation of credit, debt, capital, and other resources. To consider how contemporary inequalities cannot be detached from the structural historical conditions from which they emerge. So basically my brief remarks are in support of this larger interpretive challenge. So we might begin by evaluating the implicit yet dominant methodological assumption embedded in the study of race and finance. So I'm painting with broad strokes here, but as I understand it, the dominant methodological take, if you will, is to emphasize the individual penchants and proclivities for discrimination. Here, the individual is the unit of analysis, and racism is rarely mentioned, and instead, that which racism produces gets flattened into and is subsumed by the concept of discrimination. So one such consequence of that is to miss the sort of subtle but important distinction between, say, racial discrimination and racial exclusion, right? If we could kind of think about a basketball metaphor, racial discrimination is one in which a player is fully capable but is buried at the end of the bench and can't get in the game, but is an all-star. Whereas the other person who has full capacity to play the game and could be an all-star is locked out of the game entirely. So there's a subtle distinction between discrimination and exclusion that gets missed when we primarily focus in on discrimination. And so the focus on individual proclivities vanquishes the full accounting of the structural mechanisms through which racial inequality is produced. So to that end, I mean, what do I mean by structures? I really kind of want to focus in on two structures. One, Jim Crow segregation as a system of economic exploitation and political exclusion. And also, perhaps somewhat surprisingly, the municipal bond market. I mean, I was talking to Dr. Bostic last week, and so the municipal bond market is often imagined as a kind of stale, static domain full of conservative investors, and the real action, the real sort of conflict and story occurs over matters of equities and stocks, right? Thinking about the shareholders' revolt and such. But what I want to do is emphasize the municipal bond market and its network of bond financiers, bond buyers, bond attorneys, and sellers of financial information, and the ways in which that bond market contributed to the underdevelopment of Black America during the 20th century. So by underdevelopment, I mean the divestment from and inadequate funding of the infrastructural components of daily life, public schools, parks, roads, sewage systems, you name it. And I'm using Black America as a sort of spatial catch-all that includes the colored towns, so to speak, of the South and the ghettos of the urban North and West. So I want to contend that we cannot place that market outside of history. And more to the point, we cannot place that market outside of the dominant racial ideologies of the 20th century. Indeed, the municipal bond market grew up alongside Jim Crow segregation. The separate but equal doctrine was not just a matter of law, the courts, or state and federal statutes. That doctrine profoundly shaped the distribution of funds secured through the market. So in other words, thinking about how the racial logics basically shape the decisions of municipal officials in determining which schools will be worthy of investment and which schools will not. Or to think about the racial differentiation in terms of which schools secure, for instance, 60 to 70% of, say, $1 million loan versus 30% of that loan for Black schools. Nor was the municipal bond market insulated from the civil rights protests of the mid-20th century. And so the more interesting question, I think, is how the eclipse of Jim Crow segregation and the acceleration of desegregation where it occurred impinged on the lending decisions of bond buyers in the 1960s. So to kind of begin with, and I was kind of thinking, how would I sort of structure this talk? I wanted to begin with a case study, but realized it probably didn't have that much time to do that. So instead, I want to just kind of sit with and return to an often unremarked quote from then NAACP Executive Director Roy Wilkins. So it was December 1964, not long after the passage of the Civil Rights Act, and just before Dr. King called for an economic boycott of Alabama-made products in the spring of 1965. So we're starting to think about the ways in which various civil rights protesters are not only leveraging federal power, I should say, but also starting to imagine the role of economic sanctions and boycotts as a way of pressuring governments in the South to accelerate desegregation. So more precisely, Wilkins' remarks came in the midst of the NAACP's call to boycott the municipal bonds of Mississippi and its political subdivisions. Wilkins argued that the, quote, continued suppression of the opportunities of 45% of the state's population constituted an endless economic deadweight on the state and its political subdivisions. Of course, the 45% referred to African Americans, but he hinted at something far more layered and complex. For Wilkins, the economic exploitation and political exclusion of a large chunk of the population was, quote, bound to reduce the fiscal attractiveness of the state's securities, end quote. So Wilkins was less clear on how the credit standing of Mississippi and its political subdivisions would be reduced, but I think he was saying something like this. By locking a huge swath of the population out of opportunities, the state was bound to pick up the tab through expenditures that could be used elsewhere and to further economic growth. What's more, if not for Jim Crow, Black folks would have been better equipped to contribute to state and municipal coffers. So as it turns out, Dr. Bostic is in good company when he writes that racism is the yoke on the economy, right? For Wilkins, he similarly argued that racial segregation impaired the bonds of the state and perhaps even those held by investors at the time. So quite apart from the moral issue, to quote Wilkins, right, he concluded, those who cared about the economy should do what they could to eliminate a regime that snuffed out Black life and curtailed various rights and freedoms. So there we see, so Dr. Bostic has thought about the ways in which racism is a yoke in terms of dragging down productivity, in terms of obviating profound innovations that can radically transform and remake the economy. Wilkins is going to make a similar argument, but really talking about finance and the question of investing in and the security, marketability of Mississippi bonds, those of Jackson, Mississippi, and elsewhere. So what were the economic consequences of desegregation? And this is a question I'm just beginning to kind of think through. My book, The Bonds of Inequality, Debt in the Making of the Modern American City, is forthcoming with the University of Chicago Press. I mean, that mostly looks at San Francisco as the kind of center for a much larger story of racial inequality made through debt. But just starting to think about, for instance, the economic consequences of desegregation, or to be more precise, what were the economic consequences of white Americans who fled desegregation, taking with them illicit white racial advantages elsewhere? So a few bankers hinted at those consequences in the spring of 1963. And sometimes the archive, this is very interesting here in the previous discussion, thinking about data and this particular salience and explicit mention of race or racism. Sometimes you find these smoking guns that just demand quoting directly from the actors themselves. So if you will, I'll do that just to draw from one Chicago municipal bond banker who said in '63, quote, "Some investors fear that as school integration spreads to more and more formerly all-white districts, whites may move out of the district. What follows could be a deterioration of property values in those areas. They reason that this would eventually affect the taxes collected on that property, which, of course, are used to pay interest and to retire the bonds. Admittedly," this banker concluded, "that sort of thing wouldn't happen overnight, but remember that purchasers of municipal bonds are often committing themselves to a 20-year investment," end quote. So to kind of punctuate the point, desegregation triggered white flight. White flight, it was assumed, led to declining property tax base. Investors would still buy the bonds of desegregating municipalities. That's what's also striking about this. It's not a total aversion, but they would not do so without demanding higher interest rates. And there's another remark from a municipal bond financier who's talking about the inability or difficulty to resell Jackson, Mississippi bonds, and who more or less says, well, we can always raise the interest rate. So we might say that desegregation triggered a new form of extraction. Black folks were increasingly left behind in resegregated municipalities, resegregated due to white flight. And when those municipalities borrowed, they paid more for less. The municipal bond market then amplified the economic consequences of white flight by further disadvantaging Black areas. And so one of my main interventions, of course, is to think about the history of redlining and the 20th century housing story in tandem with the racial inequalities produced and amplified, perhaps even doubled by the municipal bond market. So, just to kind of conclude there, and then I kind of want to make sure we save some time to be in dialogue with Dr. Bostic and the audience. I guess I'd like to just sort of end with a follow-up question to what I've just said, and one which is explicitly and deliberately presentist. So if markets penalized some municipalities for desegregation during the 1960s, why do we assume, for those who do, why do we assume that those same markets and their principal players won't also penalize cities and their residents for pursuing other forms of racial justice today? And I know that's one of the big sort of questions at the end of the talk, thinking about racial justice and finance, and just want to add that particular perspective, that if one form of racial justice was desegregation in the 1960s, and desegregation could be folded into the particular calculus and evaluations of bond financiers, and perhaps even become a source of greater extraction, then what is the relationship between calls for racial justice today and the bond market and the attempts by municipalities to fund infrastructure services and so forth? So with that, I'll leave it there. Again, really grateful for the opportunity to be in conversation with economists. Oftentimes I spend my time with historians. And so it really is just a great chance to stretch and think alongside you all. So thank you.
Well, thank you, Professor Jenkins. It's really good to get your remarks and thoughts. Listening to you, the first thing that came to mind was a lot of what you're doing is describing the intersection of a financial market with other social communities, markets, and infrastructures or institutions. And I think what I'm hearing you argue is that the financial market takes those institutions as given and then just transmits its ability through that. And so if the institution that's being transmitted through has biases, then capital flows then have those biases as well. Is that really how you would describe this? And so that's one question. And the second question is, to what extent do you feel that there is intent in the financial market to discriminate? Like, is this individually present? Is it like a company or two are institutionally present? is it the whole market, or is this really just sort of a passive allowance of these sorts of things that contribute, that results in the outcomes that we see?
Well, thank you for those questions. I think the kind of, let me start with the first one in terms of the market as transmitting and perhaps amplifying existing inequalities outside of the market. Am I hearing you correct, just in terms of the framing? I would
Yep.
say that there is, of course, the amplification of inequalities, for instance, say primarily rooted in the housing market. But at the same time, the financiers, right, sort of actually existing actors, and that's one of the most exciting things about being a historian, is to kind of read the personal papers, for instance, of municipal bond financiers, or to read the Daily Bond Buyer, which is largely regarded at the time, certainly by the early 20th century, and as the kind of technical organ of the municipal bond business, is to read the financial press and to see the ways in which they're engaging in race making as well. So it is to say that, of course, the market and market transactions, for instance, are the bond market becomes a site of amplifying racial inequalities outside of the market, but it also becomes a site for race making. So just to kind of use one example, in the late 1960s, actually in 1966, 67, of course, we know about the long, hot summers of urban America, right? So we're thinking about the uprisings in Detroit, Newark, Los Angeles, San Francisco, et cetera. And one of the most fascinating things I found is officials, credit rating analysts from Moody's, Standard & Poor, who are called before Congress to explain how the uprisings are going to affect the cost to borrow and the credit standing of municipalities around the country. And it becomes this argument, this line of reasoning, that cities are lost to minorities, right? They're increasingly succumbing to minorities and labor. So that's a form of race making, in that the particular blame for the woes of municipalities are placed on minorities. And that folds into a much broader narrative with regards to the health, the general health of cities, and what is to blame for the woes, especially by the time we get to the 1970s. That's the kind of first point. Now, the other point, I guess you asked about innovation. Can you just rephrase the question for me?
Intent.
Intent,
so,
yeah.
Right. So to what extent did you see intent by municipal bond traders? Were they carrying the animus, or was it a recognition that animus elsewhere might impact adversely their prospects? And how should,
So this is the kind of where you have to be a little nimble methodologically, because, for instance, I mean, the passage I read was a kind of municipal bond financier placing himself outside of the dynamics between desegregating municipalities and investors, right? There was an attempt to say what investors will be concerned with, whereas, and to more or less sort of deny himself agency in actually raising the interest rate and negotiating the borrowing terms with the municipality. So there's the really interesting thing is the bankers themselves will sort of see themselves and present themselves as market actors, as merely responding to various signals, though they don't really use the language of price signals at the time in the 1960s, but largely responding to supply and demand and other sorts of signals. But one of the fascinating things is when you actually look at the personal papers, for instance, as I've done with one major municipal bond financier, Alan Brown, is the ways in which in internal memos, or for instance, the satirical newspapers that they produce, they're talking about Indians, they're talking about wetbacks. And so here's the thing, right? We have to imagine bankers as, sure, they are bankers who buy, sell, but they also engage in other kind of activities. And so we have to think about the ways in which the one person who wears one hat is also, of course, part of a much broader milieu, and the ways in which racial knowledge from the broader milieu creeps into and informs the practices of underwriting. So, I mean, the intent piece is really difficult in that sense, but the way I sort of get around that question, or at least try to deal with the intent question, is by, again, situating actually existing financiers in their broader milieu and how racism informs their practices.
So we have a question in the chat from Marcus Brunermeyer around the boycotting. You talked about boycotting certain municipal bonds, and he asks, does this have possible negative effects, and how do you ensure that the negative effects of that kind of a boycott are avoided? And then how would you compare it to what we're seeing now with the ESG ratings and environmental type of bond ratings? And and his last question is actually quite interesting, which is, should rating agencies be private, or should they be run more in the public sector?
Yeah, terrific questions. Thank you for that. I'll admit I'll have to punt on the second question. I'm less familiar with the ESG ratings boycotting, perhaps, or the controversy surrounding those bonds. So I have to punt on that one. But I will take the first point about the negative effects of the boycott. And this is what's really striking, is in the midst of, for instance, King's Call and Wilkins Call, and of course, these are building off of earlier efforts by CORE to also boycott different municipalities in the South, is the Daily Bond Buyer writes an editorial and more or less says it actually quite explicit, that the boycott had the effect of larger profits for bankers, increased yields for investors, and greater tax burdens for municipalities, and concluded by asking, those are all fine objectives, but is that what the protesters really want? And so here was the way in which a really fascinating and unexplored campaign actually folds into or rather serves the broader interests of financiers who, especially by 66, 67, are navigating their own cost profit squeeze, which is something I deal with in the book. And so the boycott can become part of the litany of broader creditor demands to further extract. And so that is a negative unintended consequence, but that's not, to my mind, not a poor reflection on the NAACP. It speaks rather to the outsized power of financiers in the first place, right? The very fact that they can fold a genuine, important, critical attempt to accelerate desegregation into broader forms of profit maximization says more to me about the problem of finance and the hold over municipalities than it does about the kind of poorly thought out understandings and strategy behind the NAACP. So that's what I would say. As far as the ratings, it's a great question. And this is something I deal with in the book. Wright Patman and William Proxmire, who are congressional officials in the 60s, certainly think that it should be up to the federal government for evaluating the credit standing of municipalities. And so they have in mind this federal clearinghouse that collects information and procures information to bankers or allowing for municipalities to borrow directly from the federal government. But Patman is the most explicit, and he really is the kind of, this is the Texas congressman who is the most explicit, really is kind of the thorn in the side of bond financiers from the late 50s onwards, who basically says that these bond rating officials reach up in the air, snap a rating, and place it on the bond with really and it's unclear what the criteria actually is. And when some of these credit officials are brought before Congress, they sort of move between, well, it's quantitative metrics and thresholds, and sometimes they just say it's our opinions. And one of the fascinating things is it's really just a handful of people who have such outsized power over the credit rating of municipalities, at least in the 1960s. So to the broader question, Marcus, Professor Brunermeyer, you're speaking to a much larger, longer debate between whether it should be the private sector that is in charge of evaluating the credit standing of municipalities or the federal government. I think Patman presents a very compelling case. I'm certainly persuaded by it, but I think it's worth revisiting that debate, which frankly has just been totally forgotten.
I guess an interesting question on that regard is also, like, how has that sector evolved since the 60s, and whether there's a more diverse set of players, participants, potential models. And I'm not an expert in this. This is the mundane, but on some level, it's at the heart of what cities can do in terms of investing in their local infrastructure. There's actually an interesting question from Eileen Grable about municipal bond rating methodologies as race making. She asks, in a comparative context, have you come across any studies or evidence that would suggest that municipal bonds of majority Black cities are rated lower than municipal bonds of majority white cities, holding everything else constant? Like, are those studies out there?
I welcome someone to come up with that. I mean, I don't do that work, and haven't done that work. I think it's critical, but I would just sort of say that none of this stuff is monocausal, right? I mean, I would never go to the mat and say it's all race making, and that's the primary sort of basis on which these credit rating analysts are making their decisions. But it's an important factor. And so, for instance, I mean, how does one separate when you think about the downgrades of places like Chicago, Boston, Detroit? I mean, how does one, during the 1960s, I should say, and early 70s, how does one separate the racial composition of a city, for instance, in Detroit, from deindustrialization, right? I mean, you can't separate the two and weigh one, to my mind, weigh one more than the other. But I think the crucial piece is to consider the ways in which racial inequality creates for distended ties to the formal labor market among Black folks. Deindustrialization exacerbates Black male employment, and how the structural story of deindustrialization maps onto the unemployment story, and how both get folded into credit ratings. Now, then we can think about the ways in which, again, Black male unemployment is not the result of pathology, but racial inequality in the sector, in the city more generally. And so in that sense, we're thinking about the kind of relationship between racial inequality and other such structures, how they get folded into the bond ratings, and how upon circulating those bond ratings, they do further damage or perhaps enhance the credit standing of still other municipalities. So that's the way I would approach the issue. But again, to be very cautious around sort of monocausal explanations that say that Black municipalities are penalized consistently and over time compared to white municipalities.
That's actually very interesting, and it is multidimensional. I think that's a classic research challenge that economic methods may be well suited to unpack. We have to look for some natural experiments or something specific that's happened, but that's an interesting way to think about it. Because on some level, you want to take out all the non-economic factors as potential explainers for any disparities that you see, and I think that's a very interesting thing to think about. You got me thinking much more on this. I may need to call some people and see if we can start a project. That'd be quite interesting.
And I would love to be involved. I mean, I think at one point some researchers at Penn contacted me. I wasn't sure what the full scope of their project, but I mean, I'd be happy also to think with folks about. I can't make a data set, but I could think about the different sources available one might consult to sort of aggregate the kind of historic change over time of bond ratings that then might be used to run to formulate data sets and such.
So I wanted to just close by just talking about sort of the different approaches to urban economics for what you do, or urban development more broadly. How do you think about the different approaches and what things might history bring to help the economic and finance enterprise think about these issues a bit more holistically, incorporating some of the things that you work on?
Yeah, I appreciate the question. I mean, I think for me, the basic starting point, and I have to thank my advisors in graduate school for this, is the political economy of markets. I mean, to really think about the ways in which different levels of state authority interact with the private sector, private capital, to produce, shape, and perhaps regulate various markets, whether it be housing markets, municipal bond markets. So for me, my starting point, right, as a historian is to think about the historic development of state institutions, and to not think about the market as this kind of timeless, abstract space, and to instead think about it as being constructed. And one of the things I just try to do in the book, just to sort of demonstrate that, and maybe municipal bonds to me is actually the key way to sort of demonstrate the political economy of markets. After all, it's a debt instrument issued by a municipality and a sort of municipal corporation that is bought and sold by private actors. And so at times by private actors. And so for me, I'm interested in tracing the historic development of the state markets, and then also to situate identifiable actors and to see how they stitch together the market. And so one of the things I'm working on now is it's kind of digital humanities project to map out what I call the business of debt, which identifies the major municipal bond firms and traders across the 20th century who worked in various parts of the country, to basically show these are the identifiable actors who helped make the market, and help shape urban development in various ways. Of course, there's a question of scale. We're thinking about larger financial institutions on the East Coast. Bank of America in California is a primary bond buyer, bond financier during the post-World War II period, really. And so really just kind of thinking about, right, the state, the constructedness of markets, and trying to identify actually existing people and the ways in which they made decisions, decided to pursue one course of development and not another. And of course, the other level, if you will, is the ways in which many of those financiers are also going to be involved in local government. Right. So one of the things I try to do in the book is to say that the very people who are helping to underwrite bonds are on, for instance, the bond screening committees of localities, helping to shield and decide what in fact voters see in the first place. So there's the kind of the levels of inequality and development produced at the level of the market, inequality produced at the level of local government, and many of the same people straddle both domains or both levels, if you will.
That's very, very interesting. Professor Jenkins, thank you so much for agreeing to stand up and talk in front of a bunch of economists and finance folks. I know it's a different group, but I think your perspective I know it's given me some good food for thought, and I'm really hopeful that for those of you who have been with us for this, got you thinking about some things as well, because there's a lot here. And there's a lot that just hasn't really been embraced. So I'm grateful for you. Thank you very much, sir. Oh,
I am incredibly grateful to you all for indulging a 20-minute talk without slides and graphs. But you know, I'm also happy to continue to have this conversation. Thankfully, I'm on research sabbatical. My chair told me never has a sabbatical been better timed. And so happy to continue this conversation. So please feel free to reach out, and I'll do my best to engage.
Thank you very much. Marcus, I think we'll hand it back to you. Thanks, Destin.